of you who don't know the Community Foundation very well, we thought we'd start with who are we? The Community Foundation is a 501c3 public charity. We were founded here in Asheville in 1978 by a group of very dedicated community leaders who wanted to create a permanent resource, a permanent endowment for Asheville, for this community, and for this region. Since then, we've grown considerably. As of September 30th, we have $363 million of assets under management, which makes us the third largest community foundation in the state of North Carolina, behind Charlotte and Winston-Salem. People usually ask that question, so I like to share. We are accredited by national standards. We sort of have a governing group, so to speak, called National Standards, which is part of the Council on Foundations. And we go through an accreditation and reaccreditation process periodically. I think it's every 2 to 3 years. And we maintain a good standing with national standards. We, since our inception, have granted more than, it's really probably closer to $330 million at this point to support our region and beyond. And I'll talk about that a little bit more in just a second. We serve the 18 counties of Western North Carolina, so from Burke all the way to Cherokee. Is it Cherokee County where Murphy is? And our CEO, Elizabeth Brazis, likes to say that's the size of the state of Vermont. So we have a big geographic footprint. Over 1,200 philanthropic funds, and we are governed by a 19-member board of directors that is comprised of regional leaders truly from across our region, from a representative sample of the 18-county region. We also have 21 staff, and we are in the historic Biltmore School building, which is right there, right past the I-40 interchange, so on the 3rd floor. So if you're ever that way, a lot of doctors' offices that way, come up to the 3rd floor and say hi. Our 21 staff focus on 3 main areas: grant making, asset development or philanthropy, and regional leadership. For grant making, we do discretionary grant making in 4 focus areas: human services, food and farming, early childhood development, and natural and cultural resources. We also help donor-advised fund holders, so individuals or businesses who have their donor-advised funds with us. We help them facilitate their grant making to nonprofits in our region, in our state, nationwide, sometimes even internationally. In the asset development or facilitating philanthropy, this is where we work with individuals, businesses, nonprofit organizations to establish funds. And like Nancy said, she used the word legacy, and I really like that word because most of our funds, almost all of them, are established to last in perpetuity, at least in some way, in some shape, form, or fashion. So we are about long-term philanthropy that's here for longer than we can ever imagine to support our region. And as such, we like to stay abreast of issues facing our region. We have had the opportunity, I guess you could call it, to lead when crises arise, such as the coronavirus pandemic, the floods in Haywood County with the Pigeon River, and the like. So those are our 3 main areas, and that's what our staff primarily focuses on. There's also a lot of financial work that our team does, and Graham's going to talk about that in a moment. So, nonprofit organizations, and that's sort of our umbrella term that also includes civic organizations and religious organizations or places of worship, choose to establish funds at the Community Foundation. I like to say it so that they can really focus on their work and their mission and let us focus on helping them manage their investment, manage their endowment. So this is a list of just some of our nonprofit organization funds. We work with more than 130 organizations in this region. for management of their endowments. Some organizations have multiple funds with us, and some just have one, but it's a little small, but you can see here, you know, AB Tech and Riverlink and YMCA and the JCC. So there are many wonderful nonprofit organizations in this region that we are honored to partner with for their long-term philanthropy. And now, thanks to this group and its board and leadership, you all have established the Jubilee Community Outreach Fund just last month in September. And this fund was created in anticipation, I suppose, of the sale of this building, and will house the assets. And your board and its authorized representatives will be able to determine how the funds are used. $25,000 will be permanently endowed forever. The remainder will be up to your board and your finance team, it sounds like, to determine how the funds are used. So I am going to turn it over, and like I said, there will be time for questions in a moment. I'm going to turn it over to Graham to talk through some more details. You're welcome.
Thank you. Good morning. Hope everyone can hear me okay. I've found that the world is really biased against tall people, so I'm going to lean over.
If you want, you can tilt it up more.
Okay, that seems like beyond my pay grade, but okay. Okay, raise your hand if you can't hear me. Let's put it that way. Okay. All right, so as Laura said, a lot of the Community Foundation's work revolves around managing money for the benefit of other nonprofit and civic groups and communities of faith. It's a big part of our work. Roughly a third of our assets are held in these types of structures, and we do more of this work than many community foundations do across the country. And some of the reasons are stated for you here why we're an attractive option for that. A lot of it has to do with our oversight structure, that particularly for groups and nonprofits and communities of faith that have rotating board of directors or governance structures, having our structure in place year after year, it brings a lot of comfort, and I'm going to show you sort of what that looks like in a moment. Also, because we commingle our funds for investment purposes, it creates some economies of scale and creates some benefits for organizations. And our nonprofit funds range from $25,000 on the low side up to $10 million on the high side. So we're sort of all over the map in that regard. And also, I think a really important piece that why a lot of organizations tend to gravitate towards our management is that because we aggregate our funds for investment purposes, they have access to institutional caliber vehicles. We're a relatively inexpensive way for nonprofits to have access to a sophisticated investment structure, and we'll talk a little bit more about that. So this is a big part of our work. We take our role as fiduciaries very, very seriously. Our structure is such that all of our investment activities are governed by an investment policy statement that sets the parameters and the guardrails for what can and cannot be done. All of our work is managed in compliance with the law of the land that governs such things, called the Uniform Prudent Management of Institutional Funds Act, in which the primary driving principle is meeting the standard of a prudent investor in perpetuity. We're very big on transparency as well. So all of our funds are subject to our very rigorous and thorough audit process. I've got the hair loss to prove it, and also all of our tax returns and audit reports are public information. So again, this is a large part of our work. Okay, I spoke a minute ago about oversight structure. So this slide sort of shows what that looks like. So there's three main levels here. So all of the foundation's investment activities are governed by an 8-member investment committee. All are folks that have institutional investment experience, and most of which have built their career either in or around the investment management business. So they make all of the relevant decisions regarding our investment activities. We also work very closely with a consulting firm based out of Memphis that helps to guide and do the analytical legwork to help inform the decisions of our committee. And then sort of the third rung there is the individual investment managers that we hire to actively manage portfolios. So this is something that a lot of nonprofits gain a large measure of comfort in, knowing that that type of structure is there round the clock and as the calendar flips from year to year. So that is our structure. So what is it that we're trying to accomplish? I promise I'm not going to get too deep in the weeds here, but generally what we're trying to do over longer periods of time, we measure ourselves against two basic sort of thresholds. One is a return of the rate of inflation plus 4.5% over multi-year periods. Sometimes that's easier to accomplish than others, I will suggest. And then the other being on a relative basis, we measure ourselves against a broad market blend of indices, and sometimes that's easier to accomplish than others. But that's the standard that we sort of hold ourselves up to. Okay, now, where we are right now with you folks is your finance group has decided that when proceeds from the sale of the building are generated, that they're going to create a fund at the community foundation, right? So one of the decisions around that time will be, exactly how are we going to invest that money for your benefit? And we've talked to your finance group around a variety of options. The foundation manages several different portfolios, and we've talked to them about 3 main ones so far. They haven't made a decision yet, but these are some of the options. So we have a sort of traditional endowment approach that uses active management. We also have what some of you may know the term a passive portfolio. So it's a portfolio that exclusively uses lower cost index funds and exchange traded funds. And then the option that we talked mostly about with your group was our socially responsible portfolio. So I'm going to talk a little bit about that. This is a portfolio that we've managed for more than 25 years, and it is sort of a values-oriented investment approach for donors or organizations who view their investment activities as an extension of their value system tend to gravitate in this way. And here's sort of what it is. It utilizes something called an ESG investment mandate, and that acronym stands for Environmental, Social, and Governance. This is something that has become increasingly more and more popular, particularly in the worlds of academia. So what does that mean? So in order for a company to be represented in the portfolio, they have to meet certain standards about being good stewards of the environment, being good social members of their local communities with good employment practices, and solid governance structures. And so that's what it is. I'm going to talk about what it is not. So this is a portfolio that will not have things such as weapons manufacturers or tobacco manufacturers or companies with spotty environmental track records, access to fossil fuels, that kind of thing. So, and something else that we do with a smaller sliver of this portfolio is sort of locally based. We invest in a combination of CDFIs, and that stands for Community Development Financial Institutions. So these are investments that are intended to produce a financial return, but also a social return as well. So we're investing in organizations locally that support environmental sustainability, affordable housing, local food and agriculture. So we're all over the map in this space as well. But This is, again, something that your group has expressed some interest in. And so when we get to the point where we have proceeds, they'll make a decision about which of these portfolios or combination of those portfolios they would like to use, and we're glad to work with them in all respects related to that. Okay, so we don't do this work for free, and this is our fee structure. We are an organization that we don't raise money to fund operations. We charge an asset-based fee on the funds under our management, and it's graduated. So the foundation manages a ton of different types of funds. Laura went over them, donor-advised funds, grant-making funds, planned giving instruments, that kind of thing, and they all have a different fee structure. This is our least expensive of all of them. And so higher dollar amounts are feed at a lower level. So hypothetically, if the sale of the building should generate $5 million or so, let's just use that as a starting point, that would be an annualized fee of about 0.5%. Okay. All right. All right. Yes.
Okay. Is this questions?
No. Can you hit pause for just a minute? And Laura's going to enlighten you with some more stuff, and then we'll open it up for questions. Okay.
I think just this last slide is just an example of some of the other ways that when you become a fund holder at the Community Foundation, we can add some value and offer sort of a deeper level of partnership. Graham just mentioned our planned giving platform, so if you all end up speaking with someone who wants to do a charitable gift annuity or a charitable remainder trust to support Jubilee, we can work with them to establish that type of fund using our vehicles at the foundation. We can work on bequests and beneficiary designations. We have a real estate foundation that's a supporting foundation that can accept gifts of real estate. We can help with gifts of stock, securities, and the like. So we also will offer usually about twice a year, a workshop for our fund holders to come and learn about something. Usually it's either about the work we do at the Community Foundation or about a specific sort of planned giving or investment topic. So just want to add that. Of course, then we have our grants team who's very knowledgeable and kind of has their finger on the pulse of the needs and the nonprofits in our region. So that's our final slide. We can move on to questions now. Okay. I'm going to get Graham up here because I have a feeling they're going to be a lot for him. Okay. Yes. Laura.
First off, are you guys a nonprofit?
We are.
Okay. So I'm not the brightest one in the bunch. Let me just clarify the baby version of what y'all do. So potentially $5 million goes to you. Then part of it's outreach. And what about back towards operating funds?
So the way that your fund is established, the $5 million will be in the Jubilee Community Fund, and it will be available. The purpose will be something like for the support of Jubilee and its community outreach or something like that. I'm not citing it exactly. So your board will designate an authorized representative who can decide how they want to and when they want to request funds from the fund, and you all can use it for your purposes because you are also a nonprofit status organization.
Yes. And so the $5 million is managed by professionals to the way that it's agreed upon, not some last minute decision by us guys, which is good.
Right. So
which is good.
let me chime in here. So what has occurred so far is you all have decided to create a fund, right? And then when that fund is received, funded, and invested, it will have earnings that accrue back to the fund. Your team here will decide the exact uses of that, right? So they'll decide how much of that is to go perhaps for looking for a new space for you all. How much of that is in support of your own philanthropic work that you do, your own grant making that you do. But our structure is such that we have a handful of portfolios that our investment committee manages. So we're throwing around the term 5 million as if we know that that's what it's going to be. And I want to be clear, we don't know that. But you'll be investing in a larger portfolio, and it operates just like a mutual fund, right? So that you're buying, when you add to the fund, you're buying shares. When you make grants, you're selling shares. Did that answer your question?
Yes.
Okay.
So not only will our money be managed in a more thought out, transparent way, it's going to make more money than we would figure out potentially.
Well, that's the idea. That's the idea. And our long-term track record has suggested that that's true. It's been a kind of a tough ride so far this year. I think we all know that. But Jeff, you had a question.
Graham, first of all, thank you. Your reputation precedes you as a really great organization. I was wondering about your 3 portfolios. Are there different levels of like risk reward within each portfolio we can choose, or is that within the portfolio itself?
Right. So great question. So each one, and I did not get into the weeds with each one of these, although my coworkers will tell you I'm eager to do that at the drop of a hat. So 3 options here before you, and they're all very unique with different sort of risk-return characteristics. I'd say the most aggressive of the 3 would be the middle one. The passive portfolio has a higher equity exposure. It's also the one that has performed the best over the longest term, right? But it's higher upside, higher downside, lower downside, right? The first one, the endowment model approach, we call that a multi-manager fund, and it is our largest and most fully diversified. And it is sort of a slow and steady wins the race type of approach. Lower equity exposure. When markets are going really, really high, it struggles to keep up with that, but the other side of that is true too. So in this year, even though on an absolute basis the returns have been negative, it's lost less than our other portfolios. And then I'd say most of the donors that gravitate, or the orgs that gravitate to the socially responsible portfolio, they do that out of more of a sense that it's in alignment with their organizational mission. Returns on that have been good too, but we found that that's pretty much not always the driver. You know? But the returns have been very competitive in that as well.
Can I ask one follow-up? Is that something we can change our allocation within the models? I mean, maybe that's not advisable, but... Yeah,
so I'll just say this, we're big proponents of selecting, investing long-term as a discipline, right. And that we're big believers in selecting a discipline that is in alignment with your organizational goals, and then having the discipline to stick with it when it gets choppy. But that being said, we've talked to your group about you can pick one of these portfolios, or you can pick a combination of them if you want to sort of adjust the risk profile a little bit. So I hope that answers your question.
Very well.
Can you talk about the risk profile? Tell me which one would be considered the highest risk, and the medium risk, and the low risk.
Okay. So in
You
terms,
almost said that when you talked about
that's all right. That's right. So I'd say that of the 3 options here, the lowest risk would be the endowment model approach, because it's just got a ton of different investment managers, a ton of different strategies, and hopefully what that means over longer periods of time is that you participate in the market's upside, but you limit your downside exposure. That's sort of the theory there. So again, slow and steady wins the race. That's the thing there. The bottom 2, passive and socially responsible, are more equity oriented. It's a higher allocation to equities, And so therefore, it will be a little bit more volatile, a little bit higher upside, but also a little bit lower downside. So I hope that answers your question.
So in essence, we really could do 1/3, 1/3, 1/3.
You could indeed. That's right. Many of the nonprofits that we work with have one fund, one portfolio, but we have many that like to split it between multiple portfolios. Bruce? No? Yes, sir.
So, assuming that Jubilee has some kind of long-term
I
plan.
can barely hear you.
We can't hear you.
I'll translate.
Assuming there were a long-term plan by Jubilee to using the money, let's say we were going to buy a building in 5 years, how would that influence your portfolio?
It wouldn't at all. It would not at all. So whatever is in the balance of your fund, before, let's say hypothetically you go out and you acquire a new space and you use a chunk of these proceeds to be able to do that. Whatever's left, you still have the same options before you, right? The same strategies before you. So and these are big enough portfolios that they don't, a few $1 million in and out doesn't change the strategy in a meaningful way at all.
So,
Okay.
so I think maybe we would try. So the question is, like, I know my investments, the older I get, the less risky they get, because I'll need them, right? So, so moving more towards bonds and less towards stocks, so that should I need it, it's going to be less volatile. I think is that more what we're asking? Like, if we know that in 3 to 5 years we're going to want to take a big chunk of it out, would you recommend a less risky investment option up front?
Yeah, so one of the portfolios that we run that is not on the list here, but is a capital preservation type of model that has a little bit of exposure to growth, but is slanted heavily toward fixed income. I'll caution you that fixed income is not a walk in the park these days either, but yes, it will ebb and flow as well, but the degree is lessened. So that remains an option for you.
You talked about the CDFIs that you are locally involved in. We know a lot of them. Can you name some? Are like Mountain Bizworks?
We are investors in the Mountain Bizworks Loan Fund. We are investors in the Mountain Housing Opportunities Loan Fund. We are investors in something that's not local, that's a publicly traded option that is called the Community Capital Management Bond Fund, which is the way we've slanted our investment. It's regional, like the results of our investment are all in the 18 westernmost counties of 18 of Western North Carolina, and focused on environmental sustainability. So we're sort of active in this space.
And for those of you who don't know, I worked for 8 years in this area as a grant writer, and the Community Foundation is amazing. Like, there are just all these different funds, and they've got program managers there who are very helpful to grant writers locally to try to access the money that nonprofits need for their organizations, and so it serves purposes in both directions. Like, for investors, it serves a purpose, but for people who are needing funds locally, it serves another beautiful purpose.
Yes, sir.
So the total fees that we would pay would be the fee that you charge, plus whatever fees are charged by the investment vehicle itself.
That's right.
So what would, and that would depend on the portfolio, but what are some typical numbers for the total fees?
So it's unique depending on the portfolio chosen, but they range on the low side of our passive portfolio for obvious reasons is the least expensive, and that, because there basically is no manager fees per se, so very inexpensive, so as low as 20 basis points. Our most expensive one, I'll make sure everyone understands, is the socially responsible portfolio. It costs money to have firms do these social screens. Many donors and investors in that fund feel it's worth the sort of mission-related statement that it's made. But that, in the most recently completed fiscal year, that was about, almost 90 basis points.
Can you give us that in like?
Oh, I'm sorry. I'm guilty of this all the time. So 100 basis points equals 1%. So when I say 20 basis points, that's 0.2%.
Do you know whether any of your organizations that have portfolios, have they ever used those bank as collateral to borrow against?
Not to my knowledge. I think what we end up doing routinely is we're confirming balances for organizations. If they're pursuing some sort of real estate transaction, we'll have lenders contacting us and asking us to confirm, does the organization have this level of assets with you? And we're glad to do that, but not as collateral per se. Oh, yes, ma'am.
I have participated in activities where, for instance, the state of North Carolina employees buy campaign. One of the things we could choose to contribute to was the community foundation. When you get those types of donations, where do they go?
You would think that would be an easy question to answer, but it's not. So we.
I should ask it that way.
No, it's a very good question. So usually, contributions of that sort go into one of our unrestricted grant-making funds, Fund for Western North Carolina. And so this is a fund that's, one thing we haven't talked very much about is our grant-making activities, but this is one of our largest grant-making funds. Last year, we gave away to qualified charities almost $25 million. So usually, like an unrestricted gift to the community foundation will go into that pot to fund a variety of different projects across all of our grant-making activities. Sort of vague, but that's my best answer.
Close enough.
Okay, what else can we do today?
Well, thank you all for attending.